Good afternoon, everyone. But before I start, I'd like to acknowledge the presence of Mr. Jerry Cogo from Robinsons. Thank you for squeezing time in your busy schedule, joining us today. So once again, I'm Mary Cristorino Hoson, Colliers Head for Office Services, Landlord Representation. We're very excited to have you here with us. I know everyone's excited to know how the real estate sector performed in third quarter of this year. And our program will be a tad bit festive because Joey will be presenting the data in a very exciting way. And thorough discussion on office and residential segments, which I know you have plenty of questions about. So in the next hour and so, we at Colliers will do our best to provide you insights and recommendations and perhaps some assurance that will guide us in navigating the rest of 2024 and what's in store in the industry for 2025. But before we do that, let's first acknowledge our official event partner today, the Ascott Bonifacio Global City. We would also like to acknowledge the following partners who made this event possible: ABS-CBN News Channel, Inquire Property, Business World, Philippine Star, Manila Times, Subdivision and Housing Developers Association of the Philippines, Organization of Socialized Housing Developers of the Philippines, the British Chamber of Commerce of the Philippines, Australia-New Zealand Chambers of Commerce of the Philippines, Makati Business Club, and the Shareholders Association of the Philippines. At the end of this session, we would like to invite you to stay a bit longer for a networking opportunity. Our team will be here to answer any of your questions you might have about our Collier services. And now we have released our Q3 2024 reports covering the office, residential, retail sectors. Please do not forget to download copies of these reports via the QR codes we've scattered around this venue. But before we start our program, I would like to ask everyone to scan the QR code displayed on our screen for a survey. The results we will show at the end of the program. So this one really helps our research team in gathering data and analyzing this data. So please do take your time to scan the QR code in the screen. Last July 22, President Marcos announced a ban on the Philippine offshore gaming operators by the end of this year. Today, Kevin Hara will delve deeper into the effect of this policy on the office real estate. Our data as of the last market briefing show that there are approximately 489,000 square meters of office spaces in Metro Manila occupied by POGO operators, about 3.5% of NCR's total office stock. And today we will discuss whether the new policy has had any significant impact on the office sector. But as they say, when a door closes, a window of opportunity opens, in this case, lots of windows. Other players are seen to prop up the office sector, most notably the very crucial IT BPM sector, traditional corporate occupiers, co-working service providers, and quite surprisingly, government agencies. In the residential sector, long inventory life persists in Metro Manila's condo market, but the good news is that demand for horizontal residential properties continue to sustain traction, with some developers even complementing these projects with leisure components. And finally, the sector we're all excited about, the retail segment. As many of you might have noticed, many of our well-loved malls are undergoing major facelift, and some of these renovations will finish in time for the holiday season. Joey will discuss whether this ongoing optimism in the retail sector is going to continue over the next several years. So it's all a mixed bag of the real estate industry so far this year. While there's a reason to be cautious, there's plenty more to be optimistic as well. Will it be smooth sailing for the remainder of 2024? Will external factors such as the upcoming US election have any effect on the Philippine economy and by extension the real estate industry? We will try to answer these and your questions in today's briefing. We have some questions here, Joey, so I'd like to call Kevin back and our Managing Director, Richard Raimundo, Dom Andaya, Julius Guevara, Tim Teodoro, and Paul Ramirez to help us answer these questions. I also have Ron. It's his birthday today, so please do ask questions so he can go home early. So
Okay,
from
first question, please.
from Aldous Carvajal of Anchorland, do we have an oversupply of residential condos for lease, Tim?
Well, yes, as you can see from the vacancies that were presented earlier, no, there are certain areas where there's still a lot of still high vacancy, especially since they were affected by certain office type of tenants that were exiting. You can also look at it in terms of, for certain areas, you look at it in terms of ratio of the office space versus the residential units. And so some CBDs would have a ratio that's more skewed toward residential than the office place. And of course, that affects the leasing market, which is in that particular CBD.
Ron, do we have questions at the back?
I think there's another question for Kevin first. Chris, how big of an impact will the departure of POGOs by December be to the supply chain of existing and ongoing pipeline, the office space across Metro Manila? Or Dom and Kevin, I think, can answer.
So, yeah, I'll take this one first. So the question was the impact of the POGO ban on the supply pipeline. Well, I would say that developers have already started tapering their pipelines ever since the pandemic happened. No? Before, we usually get about 600, 700,000 square meters of annual supply being pumped into the market. But that gradually was being reduced over the years since 2020. It's now down to maybe 300, 200. We just have a big supply situation in 2025 due to big developments in certain areas like QC and Bay Area, which will give us 615,000 square meters of space, new space next year. But if there is a direct impact on the POGO on supply pipeline, I would say it's more of the pandemic that already updated the developers' posture in terms of their pipelines, not really on the POGO ban.
There's another.
I'll add to
Oh, sorry.
No. I think that's why we structured the presentation in a way that, we got the POGO impact right at the beginning and delve on the details of the opportunities, because real estate players must be more incisive in the way they're looking at the data, because there are really opportunities. Even if we're talking about a POGO ban that really erased the initially forecasted 300,000 square meters of space this year. Some developers, as well as some CBDs, are already prime for new office supply. So it's not enough that we look at general numbers. We really need to look at the micro level, building level, developer level, because there are also some developers which have low stock at the moment. They're trying to grow, and this is the opportunity for them to really catch up in terms of stock by developing better buildings that are of high demand from occupiers. So yes, there's that POGO impact in terms of the vacancy, but really looking at the micro level will provide you significant insights in the way you look at the future for your own developments.
Thanks, Dom. Set of questions for Paul and Julius. I'll go with this question for Paul first. How will the development of golf communities, which I discussed earlier, impact land values outside of Metro Manila?
So as we all know, golf course is a land intensive endeavor. So for each 18 holes, you need around 30 to 60 hectare. With that alone, if developers start to really develop and focus on golf, there'll be a lot of demand for big land areas. So big developable lands, raw land, agri land will be converted for golf communities, not counting the residential support and other demand uses that can support it as well. So it will be it will increase the prices of land around Metro Manila if developers do decide to really focus on golf development.
This one is for Julius. Can you identify locations outside Metro Manila that are recording commercial lot transactions?
Okay, so in the traditional provincial areas, there's still some movements like, in Pampanga, Cebu, there are some projects in Bacolod that are now being launched that look quite interesting. So I would focus on those areas, particularly around Metro Manila, in the fringe provinces.
Pampanga, go
To
Pampanga.
add on to the question, Julius, for commercial lots, do you see commercial lots bigger or smaller, like compared to before? How big of a reduce in size are landlords selling commercial lots?
Yeah.
Okay, so that's a bit of a tricky question. It really depends on the location. If it's appropriate to have larger commercial lot sizes, the typical would be around somewhere around 1,000 square meters, right? So it really depends on what kind of footprint you can actually build. That would be appropriate for that kind of development. If it's like a smaller provincial township, then it usually would be a bit smaller than what you would find in your typical CBD here in Metro Manila.
Thanks, Julie. This is for Paul also. Will interest rate cuts result in lower land values, and when will the correction take effect?
I think, on the contrary, if the interest rates are reduced, the capacity of potential buyers to purchase the property will actually increase because of the lower mortgage rate. So it'll be easier for them to purchase the property. So I think all things equal, and just the interest rate will be reduced. I think the prices of property will actually improve.
We have a question there, Ron.
Yes, Joe and Chris, we have a question here from Michael.
Hi, I think I'd like to address this to Mr. Raimondo because it's maybe a slightly tricky question in some respects. It's more of a finance question, to be honest, but we have some very different portfolios inside of the property developers here. Some have a lot of debt, some have very strong cash flow and access to low interest rates. Do you think it's possible we can start to see some mergers or major transactions between and among developers here?
It was interesting that we were just discussing that a while ago. There should be, and we're already seeing that. I was discussing this with Jericho a while ago, that Robinsons, for instance, has already done those joint ventures. I think that is one step before those mergers. It's an easier step. It limits the liability to one development, and then you move on to the next. You test the waters for that partnership. If it works, then you move on to the next. That's the easiest one. And we've seen that. Robinsons has done with Shangri-La. You've done with Hong Kong Land. And that has actually been very successful. And I was telling Jericho that it gave the development an edge compared to the other developments along C5. Now, the other areas that we're seeing also is, we're also seeing some Japanese investors doing joint ventures to help them with the cost of development that we've seen. We've seen boutique developers as well, taking on partners. Another form of development that we're seeing also to ease the cost of borrowing is selling a certain portion of the property or of the strata title to a strategic investor. We've seen that we're in about 30% of the strata title is sold off. So that eases the cost of the building. That's another way of doing it. Mergers, maybe they would probably go with the easier routes first, unless we're seeing really distressed companies getting to that point that they need to merge. But what we're seeing right now, because of the developers here are part of a conglomerate, it's easier for them to move in their development because they have other divisions that are now making money, even if the real estate is a bit weak. So mergers, I'm not expecting more of that, but joint ventures, strategic partnerships, yes.
Ron, you have other questions? Okay, while waiting for other questions, this one is for Julius. What is the current status of the real estate sector from an investment point of view? Which segment is thriving and insulated from the recent POGO exit? Residential, commercial, or industrial?
Okay, I guess enough of this has been said about residential and office today. Some of the bright spots would be hotels. It's a point of interest today. A lot of developers have been looking at it. I think the Department of Tourism recently said that there's a backlog in rooms. It's like in the thousands. I can't remember what the number was, but most of the developers now are looking into it. Some developers that I talked to actually would want to buy existing hotel properties to add to their portfolios, because if they, it will take time for them to develop new hotels. So they're really beefing up their hotel stock. Industrial also continues to be a bright spot. There's a lot of interest in, continues to be related to logistics and warehousing, but cold storage, there's a lot more activity that we're seeing today that's related to that. Manufacturing also in certain areas, there is a resurgence. So those are some of the two sectors that we continue to see to grow, while two of the major sectors, residential office, are experiencing this downturn.
Thanks, Julius. Ron?
Yes, Joe and Chris, we also have a question here from Sunny of SHDA.
Yes, good afternoon, everyone. With the current expansion in both residential and commercial activities and also new town development, where do you think is the government? What is the role of the government specifically with respect to urban planning and overall urban and regional development? Is this an incentive also, or a disincentive to other investors and developers?
Well, in terms of government's role in urban development, so one is for them to at least have updated zoning and planning guidelines. So a lot of the provincial areas that we've talked to need to update those and take into consideration new development trends, so that these are so that the urban development in their particular cities and municipalities develop nicely with public transportation available and the proper utilities in place. And so with infrastructure, with government also putting in focus on infrastructure development, so that all of these to spur development in these particular provinces. So that's also one way that the government is able to support development. Continuous incentives, financial incentives, tax-related incentives to also help spur development, bring in investments in their areas. It's good that local government units are very active also in their particular investment units to promote their cities. So they take active roles in inviting, big developers or maybe big investors to come in and put up businesses in their offices as well.
I'd like to add to that. Probably the government can also look at, one is the VAT tax exempt threshold. Is it still the right threshold? Do we need to move it again to reflect construction costs right now and pricing? That's one. Another one that the government could help is the law to help on redevelopment. There's a law right now that they're looking at on the compulsory sale of certain buildings that here in the Philippines, you need to buy 100% of a strata title for you to redevelop. But in Hong Kong, you just have to buy 75%, and then the remaining 25%. There's a compulsory sale mechanism for you to redevelop, a 30, 40, 50-year-old building. And if you look at Makati right now, most of our buildings are old. Ortigas is another example. Give it a couple of years, Fort Bonifacio would face that problem. We need that law to be implemented for a more vibrant redevelopment in the Philippines.
Thanks, Richard. This one is for Kevin and perhaps for Dom also. With Create More, what will be the landlord's benefit if this will be passed into law?
Well, the exact effects on the market have yet to be seen, no, pending the implementing rules and regulation. But there is in the bill, if you read it, there's a it says 50% work from home provision. 50% of the workforce can work from home. Essentially, that's it. And then that's it. You know, Create More is really primarily a tax incentive law, no? Parang the work from home, it seems like it's one of the riders in that law. So we really need more clarity on that specific piece of provision. Like I've said earlier, what does 50% mean? Does it mean head count? Does it mean seats? Does it mean hours? Because there are some questions from BPOs that maybe it's about hours, so they already comply because they have multiple shifts, something like that. No? So the law is expected to pass within the year because they need the tax incentives to take into effect before the fiscal year begins in January. But the implementing rules and regulation normally takes about another 2 months from the passage of the law. So maybe in the first quarter, we'll see more clarity for Create More, particularly for that work from home provision.
Thanks, Kevin. Joey from Rizal Reyes Business Mirror, what is the outlook of REIT market going to 2025?
Well, I think for REIT, we always say this, the REIT sector, the name of the game is diversification, especially right now that we're seeing challenges in the office sector. Of course, you have the likes of RCR, for example, divesting more retail assets into their REIT. So I remember attending this hospitality summit, and during that hospitality summit, I was one of the panelists for this segment wherein we discussed the viability of having hospitality, hotel assets into the REIT portfolio of developers. Hopefully, we also see other growing, thriving asset classes, including malls, retail spaces. I believe that there's a retail REIT that was shelved, but are we going to see that finally happening in 2025 and will likely be the biggest REIT offering in the Philippines? So a lot of exciting opportunities. Yields right now ranging from 6 to 11%. Hopefully, we see a better outlook for 2025, especially as developers really ramp up their diversification strategy for their REIT assets.
Chris and Joe, you also have a question here from Rafi Mendoza of Maybank.
Okay.
Hi, good afternoon. I just have two questions. The first being, how does one reconcile the high inventory environment of above 5 years with that of top real estate developers whose inventory levels are shorter at 1 to 2 years, at least based on the briefings that we've attended as of the first half? Would you be able to provide market share estimates among the top developers versus the smaller ones? I think second question is, I think it's quite related to it as well. How far off do you think will it take for the middle income segment to gain traction, considering the more favorable interest rate environment next year? I think this is just focused on the residential segment, especially most particularly the Metro Manila market. Thanks.
Okay, so what we're looking at in terms of the remaining inventory life is overall market of Metro Manila. So it takes into it aggregates all of the performances of the big developers as well as the small ones. And so when you do the briefings with the big developers, they might have stronger sales performance versus their inventory compared to the whole market. So that's one of the reasons behind why you can see that. Also, the way we compute our remaining inventory life, it's based on net take-up. So that means we take into consideration cancellations or backouts. And I'm not sure if the developers, when they compute for the remaining inventory life, if it's purely based on the reservation sales. And so ours is net, it's kind of like reservation sales, net of backouts and cancellations.
And another thing is, the way we get to that 5 years worth of supply is, it's also based on the average take up for how long? For 12 months? For 12 months. So if your take up was pretty weak in the last 12 months, then you're going to use that to compute for a longer take up period, because the last 12 months was pretty weak. If the market starts to pick up in the next 12 months, then that adjusts. That becomes a lower number of years worth of inventory. So what we do is we aggregate the pre-sales that's not yet sold, the RFOs, the ones which are already finished but haven't been sold, and that's that inventory that we pick up. Sometimes what they report is just sometimes on the pre-sales or the RFO separately.
Thank you, Tim and Richard. Richard, just before we end, a glimpse of the 2025 forecast for Philippine property. I think you need to dust off the Colliers crystal ball for this.
Gosh, you're gonna shoot me for this after 6 months. Well, you saw the numbers. It's a mixed bag. So office, while the net take-up is basically flat, what you have to look at, as Dom and Kevin said, is you peel the layers. Unlike during the pandemic, wherein the supply was high, the demand was down. That's why we had a negative take-up. This time, there are actually transactions. We are seeing expansions. 70+% are expansions. We're seeing activity in that. The thing that kind of, the curveball was the POGO exit. And of course, you know that not all of the locations are equal. So you're now going to see locations which are doing pretty well compared to the others. We're already seeing locations wherein the vacancy is below the average. And Dom was even saying, maybe this is the right time for you to look at your redevelopment or to look at new supply that will complete in the next couple of years, because it will happen. So that's the thing for office, I think. Resi, we're not yet back to the pre-pandemic mortgage rates. I think that's the thing that is scaring people to plunk in the money is, will these interest rates stick, and will it fall further for them to give that confidence? There's no problem in the high end. There's no problem in the luxury. They probably don't need the bank financing for that. Actually, if you have cash right now, the gap between the secondary and the primary and the pre-selling in the same location is high. You could actually get really good deals, but that's mostly on cash. We are seeing a diversification in location and a diversification in product offering. I think that is the thing to look at for residential. Not since the 1997 crisis have we seen golf courses being developed again. So it took that long until developers are saying, okay, let's do golf courses again. But what's interesting this time is they're doing golf courses in a different way. Back in the 90s, they were doing golf courses as standalone, sell the shares, and let's do that as a development. Now it has a more integrated approach, because they knew what happened in 1997. They got burned in 1997. What they're doing now is it's part of a mixed-use development. It's part of a product offering. It's not just their sole source of revenue. They're probably going to earn more on the residential, more than the golf course. But, you know, it gives it a different offering. So it's a totally different approach right now. And that's interesting for me. Retail, I think we're on the up on that one. You've seen and again, I think what we're telling developers is innovate and renovate your malls, because the ones who will be left behind are the ones who will not change. I was just talking to Jericho on the Opus. The tenancy that was put in there, you took a chance. Some might work, some might not, but the fact that, you're taking a chance and putting in different concepts is very admirable, and that's how retail is, right? Not all concepts will work, but once you put different concepts, then that's the key. What else did I miss?
Industrial?
Industrial, as Julius said, the thing to watch out for right now, I think, is the online shopping has kind of plateaued because we're back, right? But then you're saying cold storage, that's a bright spot. There are still bright spots in manufacturing. So the industrial estates for that one. And then hotel, of course, we're pretty bullish on that on certain locations. I was just talking to Christine before on how you have put in your different park Radissons in different locations, and is it like 14 outside of Metro Manila in key cities? A good 3-star in key cities for MICE, for domestic tourism. I think that's the right way to go. So there are challenges like the POGO ban, right? If we didn't have that POGO ban, we would reach the 300,000 plus net take-up this year, no doubt about that. But with this POGO ban, we'll probably be flat, most likely, this year. But there are transactions. At least someone is taking up the space. It's Resi, again, it's a different challenge. If you're in Metro Manila, you're not launching anything. But if you're doing townships in Cebu, in Bacolod, in Pampanga, in Davao, in CDO, then that's a different opportunity for you. So it's now just looking at the market in a different way. Real estate is rarely a no challenge kind of industry. There will always be challenges. It's really looking for where that opportunity is, and that's how we see it.
That concludes our presentation. Thank you for participating, and hope to see you in our next property briefing.
Thank you to all our Colliers experts, led by our Managing Director, Richard Raimundo, Domandaya, Tim Teodoro, Paul Ramirez, Julius Guevara, Kevin Hara, and of course, Joey Bondoc, for always shedding light on the current landscape of the real estate sector and providing us with useful insights and recommendations as we face very promising months ahead. We would like to once again thank our event partner and official venue, the Ascott BGC. And to officially close our program, let's hear some final remarks from our Managing Director, Mr. Richard Raimundo.
Yeah, so I'd like to thank everyone. We're like, 2 months till the end of the year. Hopefully, what we see in the market right now, the bright spots, there are challenges. It would be interesting once we get back in this venue in a couple of months to see if we are able to hit those numbers. But let Colliers help you accelerate your success. If you need anything in the various business lines, just you know who to contact. So again, thank you for coming over, and have a good afternoon.
Thank you, Richard. Thank you to everyone who joined us today here at
Thank you.
Ascot. You're welcome to reach out to our team if you have further questions. If you'd like to stay updated on the latest news, insights in the Philippine property sector, please do visit our website, colliers.com. Follow us on LinkedIn, Facebook, Twitter, Instagram. And please do follow Joey. He contributes daily in Philippine Daily Inquirer, Philippine Star, and Business World. Thank you for attending our Q3 Philippine Market Briefing. For our Colliers executives, please stay on stage for a photo op before we head out. Thank you, everyone.
Thank you.